All right, so welcome. I'm Liz. Welcome to the Dairy Public Library and welcome to Demystifying Loans. I am going to turn it over to Jenna Seavey and we can get started.
All right, thank you. I'm very honored to be able to present some information to you tonight about some loan basics. We're going to cover different things like demystifying what interest rates are, what's variable versus fixed, looking out for things like predatory lending and things that will make you just pay so much more in interest and fees than if you borrowed a different way. We'll also talk about leasing versus financing an auto loan, all those summer specials that are going on at the dealerships. And then finally, we'll also summarize with some information about mortgage lending, which is another hot topic right now out in the lending world. So I am going to share my screen so that way you guys can follow along with the PowerPoint. So the program that we use is called It's a Money Thing, and this is a national program that's been put together to help really bring financial literacy in a clear, easy way to the viewer. So hopefully you find it interesting and educational. So loans are the best way for you to meet your goals, right? So it helps cover the large purchases that you can't afford to do on your own without the help of a financial institution. Buying a new car, maybe taking out loans for college or a mortgage or even a personal loan. So since they are such an important aspect of your financial freedom, we think that it's really important that you know as much as you can about the loans and what you're getting yourself into. So 5 of the major types of loans that most consumers come across would be personal loans. So you can use that money for any sort of expenses that you have. Student loans being used exclusively to pay for advanced education. Mortgages to buy that starter home or retirement property that you've been looking at. Small business loans, I'm sure you've been hearing a lot about this through COVID with PPP and lots of other resources for small business lending. And then the most common one that we see at St. Mary's Bank, which is auto loans. So some different loan terminology that we're going to go over is what a loan is made up of. And the first major portion of your loan is what's referred to as the principal, or the amount of money that you borrow. This is what you apply for and the amount that you're approved for. You may also hear it referred to as your debt or the remaining balance of a loan. So that is the principal. Another term would be interest. So interest, which is often shown as annual percentage rate, is the amount charged by your lender for borrowing and using the money that you didn't have at the front. And that APR represents yearly costs of the loan, including any additional fees that may be rolled into your financing. Another verbiage for loans would be the term. This is the length that you agree to pay back the money that you've borrowed. And we'll talk about, where your flexibility is in adjusting the amount of time that you finance a loan over and how that can help you reach some different financial goals that you may have. So what we see in lending is 2 basic types. So you have a secured loan versus an unsecured loan. And a secured loan is one that holds something as collateral. And collateral is going to be the asset or protection that your lender has in case you become delinquent on the loan. So this is generally something of value, right? So it's going to be possibly the property that you're purchasing or the vehicle that you're going to finance. There are all sorts of other forms of collateral. You could use a CD or some sort of savings account that you have as collateral to put up against lending. So depending on the different size and collateral that you offer is going to extend how much you can be given for a loan. So a secured loan is one that requires collateral. These tend to have a lower interest rate because there's less risk involved in the lender, because they do have something to offset in case you do become delinquent on the loan. A secured loan can have a longer term, which can help bring your monthly payment down to a lower amount. An unsecured loan is one that doesn't have any collateral required. So this would be just a personal loan to be used for whatever expenses that you have to use it for. An unsecured loan tends to have a higher interest rate because it's riskier for the lender. They don't have a collateral that they can go back and collect on. If you use this loan to go on a trip to Disney, I promise St. Mary's Bank will not come steal your Mickey Mouse ears if you become delinquent on this loan. But because there is no collateral, these tend to have the higher interest rate and usually a shorter term. You know, if you finance a vacation, you don't want to be paying for that vacation for 6 years. You want to be back on the beach within 2 to 3 years. There are some ways that you can lower your interest rate. So some of those would be to get a secure loan. So if you are looking for income, money to perhaps buy a vehicle, looking to get one that is secured with the vehicle will give you a lower interest rate than just getting a personal loan to purchase perhaps a used vehicle that has lower value and doesn't require collateral. It's also important to only borrow what you need. If you are going to be borrowing more that's advanced to you at the beginning of the loan, that's more that you're going to have to pay back, along with the interest that you pay with that amount that has been borrowed. You can also boost your credit score in order to get a lower interest rate. The higher your credit score, the lower interest rate you'll have on your loan because you've been deemed to be a low risk borrower for the financial institution that's lending to you. You should also know what your lenders are looking for. They want to see some solid employment history, generally 2+ years at whatever your employment history has been. No outstanding debts, good relationships with your financial institution. These are all things that can help make the difference between getting approved for a loan or perhaps needing to wait until you have more money saved up or better financial history. Another option would be to get a cosigner. Perhaps your income is not quite where it would be to get approved for a loan. So by bringing in somebody else, this can help boost that amount that you can get approved for. You know, of course, the downsider to becoming a cosigner with somebody is that if that person defaults on the loan and you're the cosigner, you take on that debt as if it's your own because you were jointly tied to that loan balance. Next, we're going to talk about fixed versus variable interest rates. And I love this image. You'll see it comes back up later in the program. So a fixed rate, consider it like the anchor, right? So this stays the same throughout the entire term of the loan. It's never going to go up or down. A variable rate is based off of the index or the market. So this can change throughout the term of your loan. If the index or the benchmark changes in the economy, your variable rate is going to go up or down. If the index goes up, so does your interest rate. If the index goes down, so does your interest rate. So right now, to have a variable interest rate, you're making out because interest rates are really low. You know, 10 years ago, to borrow when interest rates are really high, a variable rate was a much riskier loan option. Meanwhile, that anchor has stayed the same all throughout the fluctuations. So if the market does designate the interest rates go higher, you have your protected fixed rate. But at the same time, if the market rates go lower, you still have that fixed rate unless you refinance your loan. Fixed rate stays the same throughout the loan. It tends to be higher because it does have to account for those rises and falls in the market, but it can help you create easier budgeting because of its consistency. Whereas a variable rate changes, so it could be lower, depending on the index, and it can make it sometimes harder to budget for if you don't know how much that interest is going to be in your monthly payment. So those are our loan basics. The next PowerPoint that we have for you from the It's a Money thing is on predatory lending. So you have a little bit of information about loans, and now we're going to show you how to avoid a situation that is not beneficial to you for lending. So we want you to be able to identify abusive or unfair lending practices. There are government agencies looking out for these as well, but it's just good general information along with fraud awareness and protection to know what to avoid. And it can come in many different forms. Perhaps you don't have a bank account and you're currently using a check cashing service, or you have to pawn jewelry or items of value to you to get cash to pay other bills. Sometimes prepaid debit cards and other credit cards can be predatory lending. And we have our fins financing for our image for a loan shark. So these are when the interest rates are just so high that the person who does the borrowing is never going to be able to get out of that hole. So your pawn shop can be beneficial if you have the items and you're just looking to get money for them, or if you are holding it as collateral. But with this, it can tend to be an upside down situation for the person who still wants that item and is just temporarily having it on pawn so that they can pay their bills in the meantime. Payday loans can be immediate, cash in hand. However, a lot of these places will charge additional fees. So this is almost considered a short-term unsecured loan because they've taken out this percentage of your paycheck in order to hand you the cash right away. Prepaid debit cards are not necessarily, a type of lending, but these do come up as predatory because they tend to have large fees. Some of them even have purchase fees, so that every time you go to use this prepaid debit card, you're paying an additional fee aside from the one to activate it at the beginning. Prepaid debit cards are also a very common way for fraudsters to get you to send them money. Loan sharks is another predatory lending. So these tend to be extremely high interest rates. They're taking advantage of people who would maybe not traditionally qualify for a loan from another financial institution. A lot of times this is illegal activity, but it could also just be that they are just giving awful interest rates. The illegal activity would be any time that you're being blackmailed or threatened of violence for a loan that's been given to you. So we have some telltale warning signs to be on the lookout for when you're looking for a lender. Some of them should be failure to present the loan price as negotiable. Most lenders will be able to work with you as far as fees that you pay, terms, things like that, interest rates. If your lender is not willing to work with you at all, then that can be a sign that perhaps they're hiding something or not willing to give those even lending information. Don't be afraid to ask, right? It doesn't hurt. There's also unjustified risk-based pricing. So the majority of financial institutions use risk-based pricing that says if your credit score is low, you have a higher risk of defaulting on your loan, so we're going to give you a higher interest rate. If you have a high credit score, then you're a lower risk to default on your loan. You can tend to get a lower interest rate. Well, some, increases to cover potential loss is justified. You want to be looking out for people who are giving you a 18% interest rate on an auto loan, especially in today's market when the advertised price is 3 to 5%. Failure to clearly disclose terms and conditions is another warning sign that you should be on the lookout for. So you should know exactly in your closing where the money, fees, and additional payments that you're making are being divided. Mortgage loans are complex real estate transactions. So it would involve dozens of pages of legal documents. And that, if you're going through a less reputable lender, is where they can hide all of those terms and conditions that would be indicators of predatory lending. Another warning sign would be short-term loans with those really high fees. So these could be those payday loans, credit card late fees, overdraft fees, giving advanced tax refunds are another short-term loan with a high fee for that. So this fee paid to advance the money to you is actually, a significant risk for the market and a higher risk loan. Understanding the annual percentage rate. So the APR is the calculation that is really key to understanding the cost of the money that you're borrowing. Now, this is where I said that there are government agencies. The Truth in Lending Act is what governs banks, credit unions like St. Mary's, and other financing companies to make sure that they are disclosing cost of borrowing and make it easy for your borrowers to understand where money is going and what their interest rate is going to be. And you want to look out for fees. So here's a great example of, a payday lender who's offering cash money for a $50 fee, right? So this is a short-term interest-free loan for a modest fee. We'll give you $300 for a $50 fee over a $14 term, or a 14-day term, excuse me. While $50 doesn't seem like that much, if you pay it back within 14 days, the loan costs you $350. But if it takes you a year to pay back this $300 loan, the additional $50 fee every 14 days could add up to $1,300 in fees over the same course of the loan. So you can see how it really adds up, and you do have different options to borrow that $300. You could go to the payday loan and pay the $50 fee, or perhaps you have a credit card and you want to advance cash off of the credit card so that you can go purchase the new tires that you need to get your car to pass inspection. You can apply for an overdraft protection on a bank account. This is a more affordable option if you need to borrow. And then the most affordable would be borrowing from a line of credit. You want to avoid the debt trap. So if you get behind on a traditional loan from a credit union, bank, or wherever you borrowed from, you do pay late fees or penalties that one time. Now, the debt trap forces you to pay fees every single month. So in the end, the payday loan fee has increased to that $1,300 by taking it over the entire year. And this cycle is what really just makes you dig the hole deeper and you can never get back on your feet. And of course, these figures are just estimated and based off of some nice, easy math so we can really show you how you have different options in determining those fees. So the next section of our Demystifying Loans is going to get into the age-old, is it worth it for me to lease a vehicle or finance my new car? So they're the same, but they are different. So even though the car is the same, if you are leasing a vehicle versus your friend who goes and finances the same vehicle on the same day, the overall payment and term for the vehicle could end up being very different. So let's talk about leasing first. When you rent your apartment, you rent that particular unit, but your landlord owns the building. And leasing a vehicle is very similar to like renting a car for a fixed period of time. You lease a car for a fixed term, generally a lower term, like 2 to 4 years. Most leases require a deposit upfront in order to qualify. And you make monthly payments for that term to continue to use the vehicle, just like you pay your rent every month. So when you lease, you're paying for the value of the car that you use during that time of your lease. So what's left is the depreciated value of the vehicle. As opposed to financing, which is when you buy the car through an auto loan. So here somebody else fronts the money for you to purchase this vehicle, and every month through your term, which can be longer of 3 to up to 7 years, you pay back for that money that you borrowed to purchase the car. An initial deposit is sometimes and generally often required and can help you get your payment to a lower amount that you can afford. And your monthly payment goes towards repaying the balance of the loan plus interest every month. So you can finance your car right through the dealership. And what a lot of people don't know is that you can finance your car through your financial institution, like your credit union or bank that you're currently using. There are pros to cons to everything, and leasing versus buying your vehicle is no different. So some of the differences between leasing and financing would be ownership. So you don't own the vehicle, just like you don't own your apartment. You pay to use the vehicle during the specified term. And at the end of that term, you return the vehicle unless you decide to purchase it. Just like at the end of your lease, you hand the keys over and you leave your apartment. You also have a lease that lasts half the time of a typical car loan. So your ownership is considered much shorter than that of financing. And depending on the terms of the lease, you could get a new car every 2 to 4 years. Whereas financing, you own the vehicle free and clear as soon as your financial obligations have been met. You've paid back the lender for the money that you've borrowed. So then the car is yours to keep, sell, trade in, pass down to future generations, whatever the situation may be. Depreciation is different between leasing and financing. So cars depreciate, we all know this. We've been upside down in an auto loan at some point in time. So when you lease your vehicle, what you're doing is paying for that depreciation up front for the dealership. Whereas if you finance, you can expect that your new car is going to continue to depreciate every year, first initially greatly, and then less and less over time. Payments can be very different when you're looking at leasing versus financing. Leasing can generally be 30 to 60% lower than that of financing, and it can allow you to drive a car that you couldn't otherwise afford to purchase through finance. The average monthly payment on a purchased vehicle is $480, whereas most leases would get you more in that $325 range. So the benefit to this is that that monthly payment, the larger monthly payment, is because you're paying for the entire purchase of the vehicle and building that equity in your vehicle. And you can lower your monthly payment by stretching out the term of your loan or putting more down upfront. If you like to customize your vehicle, you have very different options between leasing and financing. A leased car cannot be modified. Generally any sort of aftermarket accessories, window tinting, sometimes even car starters would be breaking the terms of your lease to add this to your vehicle. So that new sound system or loud exhaust is going to be a big no-no with the leasing company for you to make changes to the vehicle that you don't own. But if you're into making those cosmetic upgrades, then you can definitely do that because you are financing this vehicle to own it long-term. Mileage plays another key factor. in determining whether leasing or financing is right for you. Most leases have a 10,000 annual mileage budget, but the average person drives 15,000 miles a year. So your lease term could have a per mile cent rate that you have to pay back. So assuming you drove 15,000 miles per year, you could be racking up an additional $1,500 in mileage fees when you turn in your leased vehicle. If you're financing, you can put as many or as few miles on that vehicle. And the only difference is that it's just going to speed up the depreciation value if you were to put a lot of miles on that vehicle at the beginning of your term. Maintenance and wear and tear are very important factors when considering leasing versus financing. Repairs and maintenance are either generally covered for a leased vehicle or they don't come up because this is a brand new vehicle that isn't going to have that wear and tear and worry about transmission fluids or engine seizing because it is a new vehicle. So since the leased vehicle is borrowed, excessive wear and tear could be held against you when you do go to turn in this vehicle at the end of the term. So if you like to park right at the front of the Walmart parking lot and there's always a shopping cart lodged into the side of your door, then leasing may not be the best option for you. Whereas if you finance your vehicle, you are responsible for those maintenance costs. There's no charges for wear and tear. So if you accidentally back into your mailbox, this isn't going to cost you when you go to turn in that vehicle, aside from the depreciation value. So we do have a sample comparison chart of leasing versus financing the same vehicle for the same amount of time. And when you look at these numbers, they do seem fairly similar, except for some glaringly obvious ones, right? So the total monthly payment is a $200 difference. But when we look at the total cost to own, there's actually not such a large difference there, right? Typically, the terms for a lease do range from 24 to, or the terms for finance range from 24 to 84 months, whereas a lease would be under 48 months. Interest rates can vary versus leases versus financing. If you see an advertisement for a 0% interest rate, make sure you are looking closely at the fine print to ensure that you understand the terms that you are agreeing to. With the lease, taxes are paid monthly as opposed to a finance purchase where that is paid right up front at the cost. Those lease payments are lower, so if you are set to a budgeted monthly lower payment, then that could certainly be more appealing to you. The lease end residual value is what the vehicle will be worth at the end of the term. So this is when you choose to either purchase the vehicle for the agreed upon price or return the vehicle and start all over again. And here we have how, those final prices look similar, but if you choose to buy your leased vehicle at the end, you're going to need to come up with $10,000 on the spot. Or take out an additional loan and start your term all over again. And that new additional loan could result in extra fees and interest. So the last portion of our demystifying loans section is on demystifying mortgages. Purchasing a home is going to be the biggest purchase of your life. Most people are going to need a loan to make this happen. So comparing mortgages can be very confusing and intimidating, not going to lie. So we're going to break it down for you to understand how the process works. When you shop for a mortgage, there are a lot of different factors that make up what that monthly mortgage payment will be. Not only is it the money that you borrow, but you also have interest, homeowners insurance, taxes, fees, and penalties that all make up that interest rate that you are agreeing agreeing to when you signed the documents for this term. So you need to understand the type of mortgage that you have. There are lots of different types. You could have a, conventional mortgage or something like that where the costs are more upfront versus paid over time. You'll need to decide between a fixed rate or adjustable rate mortgage. And here's where our lovely anchor image comes back into play. So that fixed rate mortgage is going to have an interest rate set when you take out your loan. And if you are borrowing right now, it's a really good time to borrow because interest rates are low. So the amount of monthly payment that you have is going to stay the same for the entire term of your loan if you have that fixed rate. Adjustable rates can go up and down based on the market and the index. So if it goes up, so does your payment. But for people who currently had adjustable or variable rate mortgages, right now, their payments have gone down as interest rates have gone down. So you need to weigh the benefits and the potential risk of getting a fixed versus adjustable. And there's your fixed rate. Just like with your personal loan or your auto loan, it stayed the same unless you choose to refinance your home or your auto loan. That fixed rate is not going to float to the top at any time. Having a fixed rate can make it a lot easier to budget. You know what that monthly payment is going to be, so you have a goal and something to set in mind. These tend to be higher rates if it's fixed because it has to take into account the future rising and falling of the index. Adjustable rates can change over time, so these tend to have a lower or introductory starting rate. You want to be wary of anything that could be a balloon rate. So you're paying that low interest rate initially, but then at the end of the term is when it balloons to that larger payment, or perhaps you need to come up with a whole lump sum to pay off the loan. These can be harder to budget for, but you also run the potential situation where your monthly payment is lower than expected. So you need to think of a lot of different factors when comparing the right mortgage type for you. Think about your income, your future needs, how long you plan to stay in the home. If you're just looking for something short term, then perhaps an adjustable rate while interest rates are low is the best option for you. What really feels comfortable with you is going to be dependent upon your situation and the lender that you choose to borrow from. So how do you pay back your mortgage, right? So what can be provided is the amortization schedule, and this shows you how your loan payment is broken down over the term of the loan. So the schedule will show you exactly how much of your monthly payment is going towards interest versus the principal balance that you borrowed. And paying down that principal balance is what's going to pay off your loan faster. So we use some nice easy math for our examples. So let's say you have a fixed rate $150,000 mortgage with a 3% annual interest rate taken out over a term of 25 years. You could expect that your loan payment would be $711 per month. So this is a fixed rate, so you can budget for that $711 every month until the loan is paid in full. So here is how the interest gets calculated out of that payment. So if you borrow $150,000 at a 3% interest rate, your annual interest could be $4,500. So you divide that over a 12-month year, and $375 is going in interest to your initial payment. So of that first $711 payment, even though your interest rate was only 3%, the principal balance only went down $336 because $375 of that payment went towards interest. And, you know, you've made the payment and your balance has only gone down that small amount, and you're looking to watch and see your balance go lower so that you build equity in your home faster. Interest does decrease over time. That's why it's the annual percentage rate. So as your principal balance goes down, so does the amount of interest that you pay on that loan. So $149,000 versus $148,000, you can see how the amount of interest that you're paying every month is going to go down a little bit. Now, if your payment has stayed the same, that means the bucket for your principal is going to get more and more full. So we have this great image that really shows you how at the beginning of your loan, you are primarily paying your interest. And then as you get towards the end term of your loan, that is when the interest has been paid, and now you are really just paying down the principal balance. So 3% interest rate may not seem like very much. However, to finance your $150,000 mortgage over the course of 25 years at a 3% interest rate means that you have paid a total of $213,395 for your $150,000 loan. So we want you to be able to understand before you sign, to know what you're getting yourself involved in as far as interest rates and how your payments will be divided over time. People really get in trouble by committing to mortgages that they don't understand. And that is all the more reason to know what you're getting into before you sign anything. Predatory lending was very common, about 10, 15 years ago, where lenders were offering far more money than people could afford to pay back at a higher interest rate. So every month they were getting these interest payments, and knowing that in the long run, this borrower was never going to be able to pay this off long term and would eventually foreclose on the property, but they paid their interest up front, so the bank isn't in as much of a risk. Mortgages can be a really empowering experience as well. So it can be both a curse and a blessing, right? So it comes down to understanding what type of mortgage products are available to you, honesty regarding your personal finances, and clarity about your life situation. If you don't feel comfortable with the lender that you've been speaking to about mortgages, then definitely feel free to shop around and find somewhere where you feel confident that you are not being taken advantage of or a victim of some sort of predatory lending. So that concludes our demystifying loans. We are probably going to open the floor to any questions that may come up.
Does anyone have any questions? Seeing someone unmuted. If anyone has any questions, you can either put them into the chat or you can speak up, whichever you're more comfortable with. Well, that means you did a very good job.
Happy to be able to share the information, with the Dairy Library and your community, so that people feel more empowered to be making the right financial decisions that work for them.
All right. Well, in that case, thank you everyone for coming, and you can join us next week for Demystifying Credit. Thank you so much. Welcome.
Thank you. Have a good night.
Have a good night.
Bye.